Hello, this is Richard Garza with ERA King Real Estate in Anniston, Alabama. So, you want to buy a home, but you cannot pay cash for it. Well, most people can't. You will have to apply for a mortgage. There are many different types of mortgages that can be tailored to suit your needs. To keep them simple, I have boiled them down to three main options. This is not intended to be a detailed debate on each type, but just a broad overview of the options you might have. One of your first choices is whether you want a fixed rate or an adjustable rate loan. All loans fit into one of these two categories or a combination called a hybrid. Here's the primary difference between the two types. Fixed rate mortgages have the same interest rate for the entire term. Because of this, the size of your monthly payment will stay the same month after month, year after year. It will never change. This is true even for long term financing options such as a 30-year fixed rate loan. It has the same interest rate and the same monthly payment for the entire term. Adjustable rate mortgage loans have an interest rate that will change or adjust from time to time. Typically, the rate of an adjustable rate mortgage will change every year after an initial period of and then remain fixed. It is therefore referred to as a hybrid product. A hybrid arm loan is one that starts off with a fixed or unchanged interest rate before switching over to an adjustable rate. You also have to decide whether you want to use a government insured home loan, such as FHA or VA, or a conventional regular type of loan. The main differences between these two mortgage products are that a conventional home loan is one that is not insured or guaranteed by the federal government in any way. Since they are not backed by the federal government, they normally require a higher down payment and a higher credit score. Since they are based on stricter guidelines, they may have lower interest rates. Government programs are those loans that are guaranteed or insured by the government in some shape. The three main government programs, and there are many more, are FHA loans. FHA Mortgage Insurance Program is managed by the Department of Housing and Urban Development, HUD. FHA loans are available to all types of borrowers, not just first-time buyers. The government insures the lender against losses that might result from borrower default. The advantage is that this program allows you to make a down payment for as low as 3.5% of the purchase price. One of the main disadvantages are that you will have to pay mortgage insurance, or PMI, which will increase the size of your monthly payments. VA loans. The U.S. Department of Veteran Affairs, the VA, offers a loan programs to military service members and their family. Similar to the FHA programs, these types of mortgages are guaranteed by the federal government. This means the VA will reimburse the lender for part of the loss that may result from borrower default. One advantage is that borrowers can receive 100% financing for the purchase of a home. That means no down payment whatsoever. To learn more on the VA loans, please see my YouTube clip on VA loans. USDA, or sometimes referred to as rural housing loans. The U.S. Department of Agriculture offers a loan program for rural borrowers who meet certain income requirements. This program is managed by the Rural Housing Service, which is part of the Department of Agriculture. This type of mortgage loan is offered to rural residents who have a steady, low or moderate income and yet are unable to obtain adequate housing through conventional financing. Income standards vary based on location, and not all areas are eligible. There is another distinction that needs to be made, and it's based on the size of the loan. Depending on the amount you are trying to borrow, you might fall into either a jumbo or confirming category. Here's the difference between these two types of mortgages. A conforming loan is one that meets the underwriting guidelines of Fannie Mae or Freddie Mac, particularly where size is concerned. Fannie and Freddie are the two government controlled corporations that purchase and sell mortgage backed securities. Simply put, they buy loans from lenders who generate them and then sell them to investors. A conforming loan falls within their maximum size limits and otherwise conforms to pre established criteria. A jumbo loan, on the other hand, exceeds the conforming loan limit established by Fannie Mae and Freddie Mac. This type of mortgage represents a higher risk for the lender, mainly due to its size. As a result, jumbo borrowers typically must have excellent credit and larger down payments when compared to conforming loans. Interest rates are generally higher with the jumbo products as well. I hope that this has been helpful. And like always, if you have any questions on this issue or any other real estate issue, feel free to call me. Thank you, and God bless.